Namaste guys and welcome back to the channel. Today we're taking a look at Microsoft. I'll take you on a journey. You'll sit on my back while I carry you through the jungle of all of these fundamentals that makes up this company. I'll use my assumptions about the future to generate a price target, and make sure that you stay till the end of the video because I will let you in on a little secret about what I'm doing in regards to this company. My throat is getting kind of sore for recording all of these videos for you guys, so if you want to support my my medical bill for like repairing my throat, then go ahead and subscribe down below because we're trying to get to 1,000 subs, guys. I'm not desperate, but I'm close. Holy smokers, we're looking at Microsoft here. I had no idea that this was such a humongous company. Wow. Well, oh my god. So we have to do here with a $2.3 trillion market cap. So we all know bigger market cap, less potential growth. It's just easier to grow a tiny microscopic company than it is to grow a huge company. If you've been researching Microsoft, you've probably seen some random idiot on the internet just saying like, oh, well, Microsoft is going to like 10x. Then it would be a $23 trillion company. Quick maths. So people make these crazy kinds of assumptions, and they're just they have no foundation in any kind of truth. So make sure that you keep that in mind when we're looking at this business, and I'll also talk to you about that later. Revenue of $184 billion. We have net income of $71 billion. We have a price to earnings, which is their market cap divided by their earnings of 33 almost. We have price to sales of 12.5. We have their dividends that they pay out, which is a little dividends, not much. That equates to $17.2 billion, and that is from a last year cash flow of 60 billion, so they can easily afford that dividends. Also, if you look at the average 5-year free cash flow, it's been 43, so they can easily afford this dividends. They could probably also bump that up even more, but they are probably using that free cash flow for something else, because there are 5 things that you can use free cash flow from when you're a business. It is making acquisitions, paying down debt, reinvesting into the business, buying back shares, or paying out a dividend. So they decide to pay out a tiny dividend here. So one thing that we like to look at as investors is this return on invested capital over the past 5 years. Basically the return that a company is able to generate with the money that you provide. And that has been an average 17.4% over the past 5 years. And over the past year, it has been 24%. So they are able to generate high returns on with the money that you provide, and that is one of the things that justifies a higher valuation. We'll talk about that later. Now let's see if this company is actually growing. So we want to go back 5 years and see at the revenue here. We had 96 billion to now last year $168 billion. Massive growth there. We want to see the shares outstanding either decreasing or staying the same. The reason we don't want to see this number going up is because, well, then they're diluting you as a shareholder. They're inflating the stock price. And basically they're issuing more shares, and that means that your share decreases in value. And we can see here with Microsoft, they had 5 years ago 7.75 billion shares, and now they have 7.55 billion shares. Check mark there. Let's look at their financial position. They have 130 billion in cash and short-term cash equivalent. They have almost 150 billion in long-term assets, and their liabilities is laying at 103 billion. So they can easily pay off that long-term. They can easily pay off their long-term liabilities with their long-term assets. But they can, and they also can easily pay off their long-term liabilities with their cash on hand, and even more so, even more than that actually. They can easily pay it off because it was what $101 billion, and they have 130 on hand. So crazy good financial position here for Microsoft. We want to see their cash flow increasing. Here we have 31 billion 5 years ago and 56 billion. So cash flow is basically, you can even see their expenditures here went up significantly the past year, which means they made investments in one of the other that I just spoke about. Maybe they've paid down some debt. Maybe they have like invested in other, made acquisitions or something, bought back shares. I don't know, something. But basically, the reason we want to see this number going up is because that is food for our investors. That is food for our veins, guys. This is what powers us. This is what keeps us going through the day. The free cash flow. That is what we either get paid out through dividends or they buy back shares, so we get a larger stake in the company. So here for the 8 pillars here, we can see that they are generating a nice 17% return on invested capital. We want to see that greater than 9, definitely is. We want to see their revenue growing, check mark. Net income, check mark. Shares outstanding, yeah, they're decreasing that a bit. And their financial position, great. Long-term liabilities divided by 5-year free cash flow, less than 5, check mark. Cash flow growth, check mark. And these two X's, well, they are the value indicators. And you remember what I said just before about like something with, if this number is high, then might demand a higher valuation and some other things, right? So that is why this is not the final number. This is not like, we have 2 X's here, it's a no-go. And that is the reason that we have the stock analyzer tool. This helps us determine what we should be paying for the company. So basically, put in our assumptions here, this is 10 years of analysis. So basically, what do we think that the year-over-year revenue growth is going to be in average over the next 10 years? So we have to think about, like, if we put in 100 here, that means the revenue is going to double every single year for the next 10 years. So I don't even know what that would be. They did like 180 or something billion this year. So we have to be conservative. The past years, they have like made some crazy growth, which probably isn't sustainable. Also, we have to remember that is probably baked into this number here. But you know, there's inflation, there's all these things going on. That's why it's pretty hard, to be honest, to make some reasonable assumptions here. I think I want to go 8, 9, and 10. 31.5. And a PE, guys. Right now they're trading at 33 price to earnings. That's a little bit high for a $2 trillion company. And we have to think about, this is like basically what premium are we paying? How the higher this number, the more of something we should be getting. So that could be like a good financial position, more growth in the future, or they buying back a lot of shares or something like that. So this is definitely high number, considering that we probably are over the like insanely high growth days that Microsoft have seen. Yeah, it's harder to grow a larger cap company. We all know that. So that's why I'm gonna put in some not conservative. They're pretty good assumptions here. No, that is too high. I'll put in here 14, 16, 18. And for the desired annual return, this is the return that you demand as a shareholder every year. When I click the analyze button, this will not be the price that the company is actually worth, the share is actually worth. It will be the price that you should be buying it at if you believe these estimates and you want a 12.5% return every year for the next 10 years. And the reason I put in 12.5 is because the S&P over the past century has generated an average annual return of 10.5%. So we want to apply a margin of safety, which is the 2% extra, and also we want it to be worth a while to invest in individual stocks. Hit the analyze button. Red, 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 red. So right now it just looks like, yeah, it looks red, to be honest. And well, it maybe I went a little bit too conservative on the revenue growth here, because I actually think the price to earnings and price to free cash flow is reasonable. They shouldn't be going higher than 16 or 18 in 10 years. Man, they're going to be so huge in 10 years with this growth here. So maybe let's say they keep up some, you know, over the past 5 years, then they've done an average 16%. So it is maybe a little bit too conservative that I've put in here. So let's go for these numbers instead. But I would think that they're still, yeah, they're getting closer, but they're still red. So here are my price target. This is my price target. I want to be paying 100 and yeah. So you might not think that Microsoft is going to this price under $165 a share. But you'll be surprised at like how many times this actually comes true. The stock is just overvalued at the moment. That is just how it is. So if you believe in these estimates here, you shouldn't be buying Microsoft at the moment. If you believe in some higher assumptions, maybe you should. I don't know. But this is what I feel comfortable with. So this is what I'm going to go ahead and buy when it hits this price. I put it on my watch list because I love every single thing about the company except the valuation. So yeah, I love the shares outstanding, I love the return on invested capital, I love their growth, I love their financial position, and I also think that they have a lot of growth ahead of them, but I just don't think that the market is just overbuying them, overpaying for them right now at the moment. So that is my stance on Microsoft. I hope you enjoyed the video. Make sure that you go and subscribe to pay for my medical bill, and like the video to push it out to more people. Go and subscribe, follow here on my Instagram. It's underneath my my cup here, my investing cup. So go and follow that.